So this is a resumption of where we left off, like I said, on Wednesday, and we were talking about loan types. And on Wednesday, we spent all of our time in the afternoon introducing you to sort of the Cadillac of loan types, if you will. Not that there's anything wrong with other loan types, but why are conventional loans sort of considered to be the Cadillac of loan types, if you will, or the luxury version of loan types? Why is that?
They're predictable and they're fixed.
They are predictable, they're fixed. And what borrowers typically are going to qualify for conventional financing?
The best.
Yeah,
The best.
bring up the credit.
The best.
Right. And so when we say best, we mean best from a number of perspectives. Yes, we mean credit score and credit history. That's certainly part of the qualification process. But
Yes.
generally speaking, we also mean ones that have higher down payment.
20%.
Right?
Yeah, the 20%.
Now that's why I wanted to do that. I wanted to do that because let me back up a couple of slides here and talk about that. I don't want you to automatically jump in your mind to conventional means they put down 20%. It doesn't, folks. It is true that most conventional borrowers do put down 20%, but 20% doesn't make it conventional. 20% makes it uninsured conventional. Does everybody see the differentiation there?
I'm really glad you made that point because it took me like 5 to 6 classes before it hit me that
Right.
way.
Yeah, exactly. We can have conventional loans where somebody does not put 20% down. We can have conventional loans where somebody only puts 10% down or where somebody only puts 5% down. I mean, it is theoretically possible we could have a conventional loan where somebody puts 3% down or 0. There are some 100% loan to value conventional loans. They're rare, but they
The
exist.
one thing that made me realize that was that I was working with somebody previously that had a conventional loan, but they were only putting 5% down, and that 80% was just stuck in my mind. And so you had cleared it up.
It does. It sticks there for people. I'll give you an example. One of the most popular loan products in our state is a conventional 100% loan to value loan. How many of you bank with State Employees Credit Union? Well, State Employees Credit Union offers a 100% loan to value loan. And that loan is not guaranteed by the federal government. So what's the definition of conventional? Any loan that's not guaranteed by the federal government. Well, if that one's not guaranteed, is it a conventional loan?
Yes.
Right. And they've pushed that one all the way up to 100% loan to value. So conventional simply means not insured by the government. It is true that the vast majority of conventional borrowers do put down 20%, because by putting down 20%, what do they avoid in most cases?
Insurance, PMI.
Insurance, PMI.
PMI. There you go. That's the little bit more detailed view of the thing. By putting down that 20%, they avoid this requirement of purchasing private mortgage insurance. If, however, they go above that 80% loan to value or less than 20% of a down payment, they probably are going to have to purchase private mortgage insurance. Here's what I want you to understand. Somebody borrows 95% loan to value. You can't tell if that's a conventional loan or not, because that's not what makes it conventional or not. What makes it conventional is there private mortgage insurance, or is there government mortgage insurance? Or is there no insurance at all? Because if it's private mortgage insurance, it's a conventional loan. If there's no mortgage insurance at all, it's a conventional loan. Does that make sense for everybody?
So I'm trying to place in my mind what would be an example of a 95% conventional loan that is uninsured. Would it be one?
Well, there won't be one.
Less than
There won't be an uninsured. It would be insured with PMI. So if you got a 95% loan to value conventional loan, it would be insured with PMI. not insured by the government. It's a question of where the insurance comes from.
I guess maybe my question was leading towards a loan that was being loaned out that was not equal to the property's value, but that might be a little bit more in depth.
Yeah, that's a little bit further down the line probably than we need.
I ain't no lender here.
Yeah, that's right. We don't want to become lenders today. That's for sure. So what we're trying to focus you on right now is the differentiation between what's going to make it conventional versus what's going to make it into a government-backed loan. Because what we're doing now is shifting gears into government-backed, government insured. These are loans. First question, and it's a yes or no answer. Do government-backed loans have mortgage insurance? Yes or no?
Yes.
Yes.
Yes. Yes. Absolutely, they have mortgage insurance, but they're not getting it from a private mortgage insurance company. It's coming from where?
The government.
The government.
From the government. So let me see if I can give you an analogy with a different type of insurance, and maybe you'll understand the difference here. Does Blue Cross Blue Shield offer health insurance?
Yes.
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 Does Medicaid offer health insurance?
Yes.
Yes.
Yes. Aren't they both health insurance plans?
Yes.
Yeah.
Yes, except one you're purchasing from a private company,
Company.
and the other one is coming from the United States federal government. Does everybody see the difference between the two of them?
Mhm.
Get the cheaper option.
Right? And so one is simply insurance that is administered by a government agency, Medicaid. The other is health insurance that is administered by a private company that's out to make money, Blue Cross Blue Shield. Does everybody see the difference? Either way,
Yes.
when you go to the doctor, both people have what? Insurance.
Insurance.
Loans work largely the same way when it comes to mortgage insurance. If somebody is not putting down 20%, they're most likely going to have to purchase some type of mortgage insurance. Is everybody with me so far?
Yep.
Yes.
The question is going to become, are they purchasing that mortgage insurance from a private company, which is called PMI, or are they purchasing that mortgage insurance from the United States federal government, which are called government-backed loans? Is everybody kind of locked in now on the differentiation between conventional loans and government-backed loans? Okay. So now what we're going to focus on today are those government-backed loans, the ones where the mortgage insurance has been purchased from the federal government. The first and most popular of those is the FHA loan, the Federal Housing Administration Loan Program. Here's the reason the FHA loan program is the most popular of the government-backed loans, and not only the most popular of the government-backed loans, it actually happens to be the most popular loan, period, in the United States.
Give it to me.
There's a reason for that. Number one, it's available to everybody who has any sort of legal status in the United States of America. There are no like disqualifying rules. You think about it, there are lots of loans out there that are only available to certain people. Can everybody get the state employees credit union loan?
No.
No. They have to be a member of what?
It's credit union.
Credit union.
And membership in the credit union is not open to everybody, right? You got to work for the state or have a family member that works for the state. So that it's a limited loan for limited people. Can everybody get a VA loan, a veteran's loan?
No.
No.
No, you got to be a veteran, right? So there are lots of loan programs that have very restricted sort of groups of people that they're targeted to. The FHA loan is available to everybody. Well, that's also true of conventional loans. So then why do more people inevitably end up taking out an FHA loan than conventional loans? Folks, the truth is the standards are just lower for FHA loans.
It's the new subprime loan.
It's a lower standard of lending, which means naturally more people are going to qualify for FHA loans. There are going to be lots of people who do not qualify for conventional loans, but do qualify for FHA loans. Does that make sense for everybody?
Mhm.
Okay. And for a number, and when I say standards are lower, don't get locked into just credit score. Standards means lots of things. Do you think looking at somebody's debt to income ratio, how much debt they have versus how much income they have coming in, is that a standard that a lender is going to consider?
Yes.
Yep.
Yes.
Yeah. So people that qualify for conventional loans usually have a lot of income and not much debt.
Right.
Whereas people who qualify for FHA loans but don't qualify for conventional loans, they might have more debt and less income, right? More flexible there. People who qualify for conventional loans probably have really solid credit scores. Whereas people who qualify for FHA loans but can't get a conventional loan might have some softness around the edges. Does that mean everybody who gets an FHA loan has a bad credit score? Absolutely
No.
not. It
Uh-huh.
just means there's more flexibility there. Overall, the standards are a little bit lesser. Is that sort of sinking in for everybody?
So
Mhm.
the standards are a little bit lesser because the government backs it, right? And kind of guarantees it to the lender. So they don't have to really sell it except to the FHA.
Bingo. Bingo. Okay. It is absolutely true. And I need to make a correction on the next slide here. I want to make, just notice that the federal government provides mortgage insurance. Make sure you add that to the notes here, and I need to fix that slide. Seth, if you'll make a note for me, I'll fix that as well. New slides here. The government is not lending the money. The government is not issuing the loan. The government is insuring the loan. Is everybody clear on that? And Elizabeth's comment is exactly right. Why are lenders willing to lend money to people who have lower qualifications sort of across the board? Think of it this way, folks. It's almost as if this borrower has a cosigner. Now, they don't, but it's almost as if they have a cosigner. They've got mom or dad that how many of y'all remember that first lease you had to sign when you were in college and you had to get mom or dad to come co-sign it for you? You couldn't get it by yourself. But that same person who wouldn't rent to you by yourself would rent to you if mom co-signed the lease because they knew mom was good for it. Does that make sense for everybody? And so the reason these lenders are willing to lend to borrowers who maybe have a little bit lesser qualifications is because those borrowers have the full faith and credit of the United States government backing them up through that mortgage insurance program. That's if you think about it from a lender's perspective, that's a pretty big statement. When somebody has mortgage insurance from the federal government, aren't you a lot more likely to lend them money? For sure. For sure. Because I'll tell you the truth, folks, as long as somebody can obtain mortgage insurance through FHA, they're going to find a lender who will lend them the money. Because the lender's looking at it and going, why wouldn't I lend them the money? They're insured by the federal government. If worst thing happens and they default and we have to foreclose and we can't get all our money out of the sale, who are we going to turn to get our money back?
The federal government.
We're going to turn to the federal government. That is a very valuable promise. Is everybody okay so far? Okay. Now, here's what I want you to understand before we go any further. Just like private mortgage insurance, it does not come free. This guarantee from the federal government is not free. This is not some benefit to society that the federal government just offers out of the goodness of their heart. The borrower is going to pay for this mortgage insurance, and they're going to pay dearly for it. In most cases, it is far more expensive than private mortgage insurance would be. And if you think about it, it probably should be far more expensive than private mortgage insurance because we're insuring people that are naturally a higher level of risk, right? These are riskier borrowers. because they have less of a down payment, because maybe they have credit issues, you know, whatever it happens to be for that borrower, they represent more risk. So anytime you insure people with more risk, isn't the insurance more expensive?
Yes. Heck, I might be this loan type.
Well, I was. I mean, there's a reason this is the most common loan type in the country. My first house that I bought my first house in 2000. I have to think back now. 2000. I bought my first house in beautiful Mebane, North Carolina. And at a point in time I bought it, I had just gotten out of school at Chapel Hill and I was working for the university, and my salary was a whopping $23,500 a year. Now, somebody who just got out of school and had just started working for less than $30,000 a year in their first job doesn't have a lot of cash laying around. I didn't have much of a down payment. I was very risky as a borrower. Somebody was taking a risk by lending me money. I couldn't qualify for a conventional loan, but guess what I did qualify for?
FHA.
An FHA loan. And so they serve a very valuable purpose for helping borrowers. So based on what I just said, what kind of borrowers do you think FHA loans are really, really targeted to?
First home
First
buyer.
Younger
time
people.
home buyers.
First-time home buyers for sure. First-time home buyers. This number is a number you may be tested on. What is the down payment requirement for an FHA loan? The down payment requirement for an FHA loan, at least 3.5% down. At least 3.5% down for FHA loan, which is pretty low number, which means they're borrowing. Help me out here with the math. What's their loan to value ratio on that FHA loan?
Something 0.5.
Yes, what 0.5? 90 what?
96.
96.5.
96.5.
That's exactly right. That's a 90. So that 3.5% down results in a 96.5% LTV. That's cranking it up there pretty high, folks. I mean, remember, obviously, the natural maximum loan to value is what? 100%, right? I mean, if you think about it. And so we're getting pretty close to borrowing the full purchase price. This is a borrower who's not going to be making much of a down payment. Okay. And that's one of the reasons this loan exists, because these are made to help borrowers who don't have much of a down payment still be able to purchase property. If people had to save 20% for a down payment, how many of you think a lot of the current generation of the workforce would probably be 10, 12, 15 years into their working career before they could ever even think about purchasing a property if they had to wait and save?
Majority.
Yeah.
Sure.
And
This
so,
is why the big discussion around student loan debt, because they can't save for a down payment. They can't, so they've got come out of school with $200,000 or $300,000 worth of debt. It's ridiculous.
right. And you're exactly right, because there's a lot of headwinds there for people who are entering the housing market. And the problem is, and this is what people have pointed out, and this is why things like FHA loans really are wonderful, and they have helped tremendously with people being able to get into the housing market. Right now, housing prices are appreciating so quickly that if you're sitting there trying to save 20%, aren't the prices of the houses going up faster than you can save the down payment right now?
Yeah.
Right.
For
And so
sure.
here's the beauty of somebody purchasing that house with that FHA loan. If they purchase that house with that very small down payment right now, and the value of property rapidly goes up, aren't they going to build a lot more than 3.5% equity very quickly as the value of that property goes up now that they own it?
Yep.
Yeah. And so getting in the door is a big accomplishment. And that's what FHA loans are good for. Now, remember, I can't stress enough, the government's not making these loans. The government's not setting the interest rates. These are lenders. The government is simply providing mortgage insurance. Some things that you need to know about the FHA loans. Number one, they are fixed rate loan products. Okay? What that means is the interest rate will not change. The opposite of fixed rate is adjustable rate. Fixed rate loans have interest rates that do not change. Here's the connection that you may not have made, and I've learned not to assume this, because people are not really up to speed on finance sometimes, and that's okay, but we got to get you there. Is there a direct correlation between the interest rate and the payment that's being made on a monthly basis, folks?
Yes.
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 The higher the interest rate, the higher the payment goes.
Yeah.
So
Mhm.
is there a direct thing to correlate with a fixed interest rate? If the interest rate is going to stay the same throughout the entirety of the loan, what else is going to stay the same throughout the entirety of the loan?
Your payment.
Payment.
The payment will.
Payment.
The payment will. And that's a huge statement to be able to make to somebody. That's another one of those huge advantages to home ownership over renting. If someone comes in and they get an FHA loan, they know that their housing expense, other than things like taxes and insurance, which can certainly change over time, but the biggest chunk of their housing expense is going to stay locked in and stay the same cost for the next 30 years. You certainly can't say that about rent.
While their income goes up.
While their income hopefully goes up. That's exactly right. And so it becomes increasingly more affordable. So another thing to know about FHA loans that I think may show up as a test question, they require owner occupancy. That's a fancy way of saying if you have an FHA loan on the property, you must live in the property personally. So apply that rule. What kind of ownership is not allowed with an FHA loan?
Investor.
Rentals, investing.
Investor.
Investors,
Investor ownership.
exactly right. People who buy investment property with an intent to rent it out cannot do FHA loans. Matter of fact, somebody was having a discussion, and I don't even remember in what class it was mentioned in, but somebody was having a discussion that they mentioned in one of our classes the other day, that they had run into a little bit of a problem because I do remember now, it was Dana in the night class. I remember that. Her dad was one of my students a few years ago, and he had run into a problem because his buyers were doing an FHA loan, but the sellers wanted to rent the house back for a year after the buyer purchased the property from them. And
Very particular.
that was part of the negotiation. The sellers wanted to essentially sell their house now, but then rent it for a year and live in it and pay rent for a year. The buyers agreed to that in their sales contract. Their lender, as soon as they saw the sales contract, said, no, they won't. Because you're getting a what kind of loan?
FHA.
FHA.
FHA loan, and you can't have an FHA loan on a property that you rent out. And the buyer's like, well, it's not really an investment property. We don't, and the lender said, we don't care. We don't care why you agreed to rent it to a year. You don't rent it, period, because this is not an investment property. This is your property that you have to live in. So they had to change loan types. They had to make it work and get a different type of loan. They could not do an FHA loan because of the rent back. So
Is that for the life of the loan?
Well, the note, well, you would always go look at something called, remember we talked about the promissory note, how the promissory note has all the terms of the loan. Usually there is a time period after which, and it can vary from note to note, after which you would be allowed to rent it out if you chose to. There's usually like a cooling off time period, but you would need to go check the note.
Gotcha. Okay.
Yeah.
Because I have a townhouse and we've thought about, do we want to rent it out or do we want to sell it and use the money for down payment on something else? So,
Sure.
Okay.
So just go look at your note.
Gotcha.
Look at your promissory note. It'll say. So your interest rates on FHA loans are going to be set by the lender, not by FHA. The property's got to be appraised by an FHA approved appraiser. There's no getting around that. You have to use an appraiser who's been certified by FHA, and appraisal cannot be waived for FHA loans. There is no prepayment penalty. Look at that. Y'all remember we talked about that prepayment penalty clause that might be in some loans?
Mm-hmm.
What about FHA loans? You're going to be tested on this. Do FHA loans have prepayment penalties?
No.
No.
They do not. So here's the thing. And people say, well, I thought the government wasn't making these loans. So how can the government set all these rules? Here's how the government sets the rules, folks. They simply say, you don't get the mortgage insurance if this loan has a prepayment penalty. So they're looking at the lender going, you do what you want to do. But if you want us to insure this loan, you'll eliminate that prepayment penalty. What do you think the lender's going to do?
Okay.
Okay,
Administer the loan.
okay, because the lender wants that insurance. They want this
You
loan
do
to be
you, boo.
by the federal government, and so the lender will agree. Another thing to understand about government-backed loans, at least as far as how they're going to be tested, is they are assumable. So here's the connection I want you to make. Didn't we talk about, this is going to really test you now. Did we talk about a certain clause that if it was in a note would prevent assumption? Does anybody remember which clause would prevent assumption?
Alienation.
You won't say,
Good, the due on sale or alienation clause. So if FHA loans are assumable, do they contain a due on sale clause or do they not contain one?
They do
They
not.
No.
No.
Do
they
not.
don't have one.
They do not, because if they had one, they would not be assumable. Does that make sense for everybody?
Mhm.
Okay, so they don't contain a due on sale clause and they don't contain a prepayment penalty. The most common type of FHA loan is the 203B. You don't need to memorize that. I just want you to not freak out if you see it on a test. It's extra information they like to throw in there. And I think people just go nuts. I don't know what the 203B. It's an FHA loan. That's all it is, right? So don't like go nuts over that. The
you
only
wouldn't
thing,
throw Elizabeth off.
right? No, Elizabeth knows, that's for sure. But the only thing I would just point you to is that the 203B is not a loan that can be used for condominium purchases. FHA does have condominium loans, but it's a little bit different loan product. They have different rules when it comes to condominium purchases. And there's a valid reason for that. Think about all the way back when we talked about condos. What makes condos different than almost every other real estate purchase? What is not part of a condominium purchase that is the most
Land.
important thing?
The
The
land.
outside of the
The
building.
land.
Land,
Come
on.
land, structure, right? Remember, the land and everything attached to the land is not part of a condominium purchase, right? It's airspace.
Airspace,
And
yes.
so when you talk about condominium purchases, lenders are a little bit more leery. I'll tell you why there's a different FHA loan program for condos. They're going to want to investigate the HOA. They're going to want to look at and see, okay, what kind of system is in place here for maintenance? What kind of system is in place for paying the property taxes? And so there's a separate loan program for condos. We don't need to go.
FHA has a list of their approved condos where you can go to their website and look it up. So if you're working with a client that says they're looking at condos, contact the lender right away and tell them that.
That's exactly right. That's exactly right. Not all condominium developments will, can you even get an FHA loan? There are the development, the HOA has to be approved by the FHA. They are not fully insured. Remember, we talked about that on Wednesday. Loans are never fully insured. They are never fully guaranteed. They are only partially insured. Just like any other mortgage insurance, what's the magic loan to value number where the insurance kicks in and starts to provide coverage to the lender?
81%.
81.
80 and up. That's right. 80 and up. They start at 80 and they go up from there. That's exactly right. Okay. And so this does protect the lender against some of the risk, not all, because you can never, it wouldn't be a loan if the lender was taking zero risk. I mean, let's just be honest. If the lender was taking absolutely zero risk, it wouldn't even be a loan. It would just be like, cashing in. I don't know what you would call it. Yeah, right. Help. Right. It would. And so there is still some risk, but the riskiest part of the loan is insured. I think that's the best way to think about mortgage insurance. Mortgage insurance doesn't insure the loan. It insures the riskiest part of the loan, that top piece that provides so much risk. The other big government-backed loan program is the VA loan. The VA loan program, which it comes from, VA stands for United States Department of Veterans Affairs. The VA loan program, or VA guaranteed loan program, is a program for veterans. These are loans that are made specifically to veterans of the United States military, the United States Armed Services, the 5 branches of the United States military. I refuse to acknowledge that there's a 6th branch of the United States military. I will probably get over that at some point. But Space Force just sounds like something out of Spaceballs to me, and I can't do it. I cannot bring myself. I saw a recruitment video for it. the other-
Intergalactic Wars, it's coming, y'all.
I'm sorry, I just giggled. I'm like, Space Force. What is that, like a Star Trek convention? I don't even know what y'all are going to be doing over there. So sorry. But we're talking at this point, at least, veterans of the United States Army, United States Navy, United States Marine Corps, the United States Air Force, and the Coast Guard. Those would be people who would qualify for obtaining a VA guaranteed loan. Just like the FHA loan program, VA is not lending money. They are providing insurance. Does everybody see the difference there? The VA is not lending the money. They are simply providing insurance. Who's still making these loans, folks?
The bank.
Banks are. Bank of America and Chase and Citibank and all those kinds of things. In this case, though, the insurance is just coming from the Veterans Administration on these loans. In order to obtain a VA guaranteed loan, and there's a pretty big benefit to obtaining a VA guaranteed loan. In order to obtain one, you have to be what we call a qualifying veteran. What does that get you? Well, it gets you access to something that not a lot of Americans have access to automatically, which is the ability to finance a home while putting how much money down, folks?
None.
Zero. Because the VA guaranteed loan program is a 100% loan to value. So compare that to the FHA. FHA doesn't require much of a down payment, but it does require a down payment, 3.5%. That's a pretty small number. But when you apply that to a $300,000 house, that's over $10,000. So, that's a $10,000 down payment that a veteran does not have to make if they are purchasing using a VA loan. So that's one major benefit of the VA loan program, is that it's 100% loan to value. I can guarantee you this second bullet point is going to come up as a test question. This is the one that I think just floors people for whatever reason on the test. And I'm not sure why, but there seems to be a misconception out there that with VA loans, the buyer cannot pay more than the appraised value. And the truth is they can. The buyer can. The buyer can pay whatever number they want to pay. If the property appraises for $300,000, can the buyer pay $350 if they want to?
Yes.
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 Here's
But
what
the
you,
insurance by
here's what you
300.
need to understand. VA doesn't care how much you pay for the property. They simply care how much they will lend on the property. And there is a difference. The VA loan caps out at 100% of that appraised value. So when that VA borrower who's agreed to pay $350 for the house, when the appraisal comes in at $300, are they going to have to make a down payment even though they're getting a VA loan?
Yes.
Yes, and a big one, right? Because that $50,000 difference is going to come out of their pocket. Does that make sense for everybody?
Mhm.
Okay.
Yeah.
So and that's actually a good thing. I've heard people say, "Oh, that's terrible." No, it's a good thing, because if the rule was they could never pay more than the appraised value, right now veterans wouldn't be able to purchase homes, period, with these loans, because almost none of them are appraising right now.
I think this is Southern Pines, right? Because we have the air base here, or the Army base here at Fort Bragg.
Yeah, Brad.
Those people are buying and dramatically escalating our sales prices, because with the low interest rates, it's cheaper than renting and they don't have to put anything down. So it's driving the prices up, making it unaffordable for people who aren't in the military.
Yeah, I can see that. And they're in some ways competing with each other because it is such a huge concentration of those same buyers in the area. So I could certainly see how that would be the case. And you're right, with the low interest rates, if somebody doesn't have to make a down payment, well, you know, what's another 20 bucks on my mortgage payment if I can get the house I want? And so I could see where that could have a dramatic escalation impact on pricing for sure in certain.
And one other thing, Travis, they can go over 100% because they can borrow the closing costs. So you
Well,
can
and-
get to
and
101.
Yep, and that one's coming. That one's coming. So I appreciate that. So
Travis,
yes,
isn't that normal that you cannot borrow over the appraised amount?
well, in most loans, you can't even borrow the appraised amount, Taj. Remember, in most loans, you're already having to be capped out at 80% loan to
Right.
value, 90% loan to value. And so it's always true that you cap out at 80% of the appraised value or 90% of the appraised value if that's your loan to value ratio. People make that connection with other loans because they expect you are already paying a down payment. People understand for whatever reason on the test, people seem to get it. Okay, if I'm doing an 80% loan to value loan, I'm borrowing 80% of the appraised amount. Everything else comes out of my pocket.
Right.
But because of the perception of the VA loan with not having to pay anything out of pocket, it misses people that there are buyers with VA loans who still have to pay money out of pocket because they can't borrow 100% of the purchase price. They can borrow 100% of the appraised value.
Okay, gotcha.
Does
Okay.
that make sense?
That's a misconception, yes.
It's the same idea. It's really no different than any other loan with their maximum loan to value ratio. It's just because the VA loan, people have this expectation of no money out of pocket. Somehow they feel like, well, you should just be able to borrow $12 million on that house if you want to. And it doesn't work that way.
Okay.
It doesn't work that way.
Travis, it's always the rule of thumb is it's the lesser of.
Correct.
Either the purchase price or the appraised value. It's going to be the lesser of.
That is correct. That is exactly right. They're going to use lesser of the appraised value or the purchase price, which of course, in most cases, the lesser number is the appraised value. That's usually sort of the limiting factor there. Very often buyers have gotten, sort of out beyond their skis, so to speak, and gotten ahead of the game. And because they want the house, they're emotionally tied to it and they're willing to drive that number up. And then the appraiser comes in and gets to be the bad person in the transaction to say, I don't know what y'all saw here, but I don't see it. And, and then that creates issues because all of a sudden, because you have to think about the implications of that. If you have this veteran buyer, it has been ingrained in them almost to a cultural level that they can buy a house and not put any money down. Does that make sense for everybody?
Yes.
And so you have to think about the transaction process. They go in, they look at a house, their spouse, their children fall in love with this house. And then they make an offer on it. The seller got 12 offers. So now they're in a competition. Everybody following me on that?
Mhm.
And they want to
Yes.
win, right? They want to win. And so they drive the price up, just like Elizabeth mentioned earlier, with, fighting with other buyers. In their mind, that doesn't matter because, it's just an extra 30 bucks on my house payment until they get under contract. And then comes the big bad appraiser in the door. And the appraiser goes, now I see your contract here says you're paying $350 for the house, and you're more than welcome to do that. But here's what I'm going to tell the lender. I only see 300 here. That's all I see. And when you tell when an appraiser tells the lender they only see 300, guess what the lender is going to base their loan amount on?
300.
300. And so what happens in that case is now we got to go back to a buyer who may not have been planning to put any money out of pocket and say, you need $50,000. Boy, you talk about somebody that can get bent out of shape in a hurry over something like that. And that's why, Taj, back to your question, we really do have to hammer it about these VA loans because there is such that perception around them of no money down, no money down, no money down. Well, that's only true if your purchase price and the appraised value align with each other. Okay. Does that make sense for everybody?
And you best believe VA appraisers are very conservative.
They are. They
Oh
are.
my gosh.
Yeah, I mean, VA appraisers are going to be the most nitpicky ones in the bunch for sure. I mean, so you're probably going to get a lower appraised value from a VA appraiser than any other appraiser, quite honestly. So, that's another wrinkle that comes into the picture.
And they can
Travis.
also require that stuff be done. Like
They
they don't
can.
like the chip out of the sink in the bathroom or the chip in the linoleum in the kitchen. And it doesn't matter if you're planning on on remodeling, they want it done before the close.
Before they land on it. Exactly.
Yeah.
Travis, I have a question. Would you say that it's hard for someone to purchase using a VA loan right now with the way the market is?
I would say yes right now, because here's what I will say. Sellers are very leery of two things about the VA lending process. Notice I said sellers, not buyers. Because
Yes.
remember, if you're trying to purchase, who are you trying to impress?
The seller
right?
Yeah.
If the
against
seller-
many offers.
against all
Mhm.
these other offers. The sellers are, it's like a beauty pageant. The seller is
Yeah.
sitting back and lining up the buyers, and they're like, no, I don't like number 1. I don't like number 3. Get rid of number 10. But they're not looking at the looks of these people. They're looking at their offer, and they're
Mhm.
looking, and part of looking at their offer is going, well, how are they paying for the property? And when sellers see VA loans, here's what pops through their mind. What are we going to do when it doesn't appraise? Do they have the cash?
Absolutely.
Yeah.
Do they have the cash if it doesn't appraise? Because we know those VA appraisers are crazy. They come in here and they nitpick everything. And then when the VA appraiser comes in here and says, I got to replace the tub, or I got to replace the light fixture, or I got to paint the eaves on the outside of the house, am I willing to deal with all that? When I got a buyer over here, put yourself in the seller's shoes. When I got a conventional buyer over here who's already putting 20% down. So if theirs doesn't appraise and they have to put a little more down, probably not a big deal to them.
Yeah.
Exactly.
And
they're
I
sitting
know
there-
that conventional appraiser's not going to ask us to fix a thing. Which one
Right.
is the seller likely to choose?
And
Mhm.
just touching
Conventional.
base on that, they're looking at it like the seller is, as any seller would. What potential problems is going to come up in this? Am I going to have problems with this other loan that's conventional?
Exactly.
Mhm.
That's exactly right. Now, so that we talk about how that the borrower is allowed to borrow the full amount that comes from the appraisal, which is called, by the way, a certificate of reasonable value when it comes to the VA lending process. That's the name. It's a CRV, certificate of reasonable value. And the borrower can choose to pay more than the CRV amount. They just have to pay the difference out of pocket. Okay. Everybody good so far?
Mhm.
Okay. Now, good.
And just tailgating, Travis, I guess it wouldn't be a bad thing to advise your VA clients, like, hey, you might want to see if you want to go for a conventional route or FHA
Oh, I think
route.
that's the perfect advice right now. If you have somebody come to you as a buyer says, well, I'm planning on doing a VA loan, and they're in a really competitive marketplace, you might say to them, well, maybe we need to talk about that. Maybe your offer would be better perceived if it was a conventional backed offer versus a VA. Might give you a better chance at getting a contract. Okay. So you need an entitlement to a VA loan. This will show up on the test for sure. Okay. You've got an entitlement to a VA loan. The entitlement is not a one-time thing. The entitlement sets the amount of a VA loan that someone can obtain. Not all veterans can obtain the same dollar amount in a VA guaranteed loan. The amount of their entitlement is set based on the length of their service, their rank. So as an example, in our household, both our fathers are former military. My dad's former Army. My father-in-law is retired Chief Master Sergeant Air Force. Now, my dad spent 7 years in the Army and then decided that was not the career path he wanted to be on. So he has a VA entitlement from the 1970s when he was discharged. My father-in-law retired after a 35-year career in the Air Force, where he was a Chief Master Sergeant, which is the highest rank you can obtain as an enlisted member of the United States Air Force. Which one of them do you think can borrow more money with a VA loan?
The chief master sergeant.
Wow, yeah.
That chief, those stripes are worth something. when it comes to taking out a VA loan. It's almost laughable. My father-in-law's VA loan entitlement is $800,000. So he could go out and buy an $800,000 home, no money down, because of his length of service and because of his rank. I think my dad's VA entitlement, which is still nothing to scoff at, I think is like 287 or right at 300 something, but that's from the 70s. That's not bad, so dad could still go out right now, and he's not using his entitlement, that they could still go out now and take out a VA loan. Everybody okay with that?
Can your father use his, can your your father-in-law use his VA and buy, say, a $400,000 second home on the lake and a $400,000 primary residence?
He
That
can.
possible?
He
Okay.
can. That's a great question. Yes. And so with the VA loan entitlement, you can split your entitlement into multiple purchases. So if he wanted to go out and they wanted to buy a house on, on one of the lakes up in Michigan, for example, they could do that. And actually, I'll go one better for you. He did recently use his VA entitlement. They bought an RV. You can actually use it on a motorhome. And he used his VA loan entitlement, and they bought a motorhome with it. And so they go all around the country, and and they actually use the VA loan to purchase the motorhome as a second home, which I thought was super interesting. So they were able to essentially sign and drive because they did no money down on a motorhome purchase with a VA loan.
Can you use it as a second mortgage as well?
You can.
Yes.
Yeah, you can. I mean, there's a lot of flexibility with these VA loans.
What about
So-
investment?
I'm sorry.
What about an investment property?
So it's not allowed to be used as a strict investment property, but there is a lot more flexibility about renting it out after you purchase it. What you're not allowed to do is purchase it and just with the plans of renting it out. But for example, if you purchase it as an owner occupied home and then a month later you get a change of station, you get moved to a different base assignment somewhere, you are allowed to keep that property as a rental or investment property. You don't have to sell it. You don't have to refinance it. And so a lot of people who are currently in the military will intentionally do that. They'll know that they've got a change of station coming up, and they'll buy a property in the area knowing that they're going to be relocating in a couple of months, but it'll be their home for a month or so, and then they'll rent it out after that because that flexibility is there and allowed. And so essentially now they've got, an investment property collecting rent and earning them some money. So there's a lot of flexibility there. No prepayment penalty on these VA loans. They are assumable. This will show up on the test because I think people are shocked to know this. Not only are VA loans assumable, and remember, assumption is always, and more in theory than in practice type thing, but they are assumable by anybody, not just vets. So, as an example, if my father-in-law did go out and buy a lake home in Michigan and used his VA entitlement to purchase that, and then 2 years later, he decided to sell the property, could Molly purchase the property from him and assume his VA loan as long as he was okay with that? What do y'all think?
Yes, yes.
As long as she qualifies.
Yes. Molly's got to qualify through the financial means, but what Molly doesn't have to have is a VA entitlement, because essentially what's happening there is the veteran is allowing Molly to take over their VA entitlement in that property.
But
And
if she takes over the VA entitlement, then he doesn't have it to use on the next property.
And
Until he sells it, he doesn't get it back.
that's exactly right. His entitlement would stay tied up in that property that he allowed that assumption. So he's basically giving up his own entitlement until that loan is paid off.
That's the same if he was to rent it out though, right?
Same if he was to rent it out.
Yeah.
That's exactly right, because the entitlement would still be tied up in that property. That's exactly right. That's exactly right. So you think of your entitlement as like, you almost trade your entitlement for the loan, right? If you're entitled for $300,000 and you go out and you take a $300,000 loan, you trade in your chip. They give you the loan, you give them your entitlement. When you pay the loan off, guess what they're going to give you back?
Entitlement.
Your entitlement.
If you let somebody assume the loan, you don't get your entitlement back because it's still traded in for the loan. Now, 20 years down the road, when they pay the loan off, guess what you'll get back?
Your entitlement.
Your entitlement.
And then you would get your entitlement back. So that's how the assumption works when you have VA loans. And then the last note about VA loans, and this is a test question for sure. And Elizabeth mentioned it earlier, and I said it was coming up because this is one of those things that rattles around in people's brains and then they just fall on the floor dead because it melts their brain. It is true that a veteran can only borrow 100% of the certificate of reasonable value or the appraised amount of that property. They can only borrow that amount. Is everybody clear with me? So if the house appraises for 300, how much can we borrow?
$300, 300,000.
300,000. Everybody with me?
Yes.
Maximum loan amount. However, that's not the maximum that veteran could end up owing on that loan. Their actual loan amount can be more than that because the VA loan is more specifically 100% loan to value plus any closing costs that you'd like to roll into the loan. So could somebody who borrows 300 on that house end up owing 305 when they leave the closing?
Yes.
Yes, because they have chosen not to pay their closing costs. Because here's what you need to understand. Whenever you have a closing, there's going to be thousands of dollars in closing costs in most cases. And most buyers pay those out of pocket at closing. But veterans are allowed to essentially say, nope, not only do I not want to make a down payment, I also don't want to pay my closing costs. Just tack them on to the loan. Does everybody see that? The distinction there? So house praises for 300, maximum loan amount is 300, but the maximum balance owed could be 305, 306, because that veteran could have chosen to roll their closing cost into the loan, essentially borrow the closing costs as well.
It helped me a lot to think of these two things as like, you know, two columns. You have the balance, which is the entire thing, and then part of that balance is the loaned amount.
Right.
It helped me.
Right. And so I gave you an example down here. It says Karen uses her VA eligibility to purchase a home for $250,000. She borrows the full purchase price and elects to roll in her closing costs. She has $5,000 in closing costs. So what's the maximum she can actually end up owing? If she's paying $250,000, it appraises for $250,000, and she wants to roll in her $5,000 in closing costs, she can actually end up owing a maximum of what? $255. Now, here's what's interesting. If she had promised on the contract to pay $255 and it appraised for $250, could she borrow the $255? What do you think? No. It does not work that way. So she's
not borrowing that.
You're right. They won't let you borrow more like that. They're gonna set your maximum loan amount as, you know, and so sometimes I have to have this discussion with VA buyers, because I've had VA buyers are like, well, no, I'm going to pay my own closing costs. I'm not going to roll those into the loan. And then their appraisal misses by $10,000. And they're like, well, I don't know what to do. I don't have an extra $10,000. I said, well, how much do you have saved for your closing costs? And they're like, well, we got like $8,000 for the closing costs. I'm like, well, then just roll the closing cost into the loan. At the end of the day, does it really matter to you that you're paying the $10,000 as part of a down payment, or that you're paying it as closing costs? It's still $10,000 out of your pocket. Does everybody see the difference?
Mm-hmm.
Do you pay interest on rolling that in?
Oh, yes. Absolutely, you do, for sure. And that's the downside of rolling it in. You will pay more because you'll pay interest on it.
You have to have a conversation with them about the fact that mortgage debt is good debt. It is the only tax deductible debt, because a lot of people don't want debt at all, and I can understand that, but you're gonna need a tax write-off, and interest is the only one that's there.
Very true. How do we all feel about the VA loan program there? Everybody okay?
Mhm.
Okay, good, good. I think we covered. So the rest of the section here, and it won't take us long at all to go through these because we're not going to get nearly to the detail about these other ones. The rest of the section deals with much rarer, far less common examples of loan types that you basically just need to be familiar with on a surface level, so that if you see them on the test, you're like, oh yeah, that's that. You don't need to know how they work. You don't need to know the depth of what somebody can borrow. You don't need to know loan to value ratios. The only loans that you need to know in depth, there are 3 of them. What are the 3 loans that you need to know in depth that we've covered already?
Conventional.
FHA, and
MBA.
VA. Those you got to know in detail. Okay. And that probably covers, honestly, folks, 97% of all lending. I mean, you know, and that is the vast, vast majority of all lending right there. So these other things that we're about to talk about, this is the, you know, like the 1 in 50, 1 in 100, you know, type stuff, just random rare stuff. Seller financing, which is also called a purchase money mortgage. Okay. So they mean the same thing. 2 names that, and actually 3 names. Sometimes people refer to it as the seller taking back a note. They all mean the same thing. It's just 3 things right here that all mean the same thing. Okay. Not 3 different types of loans, 3 different names for the same loan. This is a loan where the seller is loaning the money to the buyer. The seller is actually functioning as 2 separate people here. They're the seller, but they're also what?
The lender.
The lender. The buyer is choosing to borrow money from the seller. In this situation here, the seller is going to place a lien against the property that they used to own. Now, they're not going to own the property anymore because they just did what with the property?
Sold it.
Sold it.
They just sold it. So their role as a seller, and by the way, were they paid for the property as a seller?
Yes.
Yes, they were paid for the property by the seller with money that they loaned to the buyer. And that's why they no longer own the property, because in the eyes of the law, the buyer has paid for the property. Does that make sense for everybody?
Yes.
Okay. This is not the seller's property anymore. The buyer paid for it. The buyer does, however, owe money, just like they would owe money to any other lender. So is the buyer going to sign a promissory note?
Yes.
Yep.
Yes.
And if we were in a lien theory state, what document would the seller need to record at the courthouse to give them the right to foreclose?
A
Deed of
mortgage.
trust.
Lien
Deed
theory.
of trust.
Oh.
Deed of
Lien
trust.
theory. Oh,
Mortgage.
lien theory.
Mortgage.
Mortgage.
Or in
Oh,
a lien
mortgage.
theory, they would need to record a mortgage. Title theory, they would need to record.
Deed of trust.
Deed of trust.
Great key.
There you go. Deed of trust in a title theory state, mortgage in a lien theory state.
I think that's really cool though, because you don't really think of these things as being a publicly recorded document, but it is.
Right.
I think that's really cool.
Because it creates the right to foreclose on the property. And this seller has the right to foreclose the same as any other lender would, because that's what they functioned as in this transaction, as the lender. Now, why do you think this is rare? Well, most sellers don't want to do this for obvious reasons. Most sellers want to be hand washed. I'm done, right? Out. They don't want to be collecting payments from the buyer. They don't have to be worried that the buyer may default. But it does.
They want their
happen.
money.
It does happen, especially if you've got a property that has proven hard to sell and you have a buyer, but the buyer is having a hard time getting financing. You see this a lot with land. It's very hard to get financing on raw land. A lot of buyers who are well qualified, who could go out and buy $1 million house with no problem, just boom, I could get that loan tomorrow for this borrower. Want to buy $1 million piece of land, and the first thing the bank tells them is, well, you need 50% down just because it's land. You need 50% down. And the borrower's like, what? I need 500,000 and they don't have it. Well, the seller's in a pickle because they've got this piece of property that they want to get sold, and everybody who's trying to buy it's having a problem getting financing. Does that make sense for everybody?
Yes.
So if the seller has some, some cash availability of their own, they can step up and they can become the lender. And then
So,
they'll collect.
One other thing in today's market, the bank is only going to give them 2% on the money.
Mhm.
And as a seller carrying back the financing, if you're older and retired, you can get a better interest rate by you can charge the buyer 10, 12%, whatever you want to charge them, to make the loan, to offset your risk. So, worst case, you get the property back.
That's right.
Mhm.
So those are purchase money mortgages, and which is called seller financing or seller taking back a note. Another fairly uncommon loan program, and I say fairly uncommon, this is going to depend largely on where you end up working in North Carolina if you work in residential real estate, is the USDA Rural Development Loan. If you are in a rural area of the state, you might see quite a few of these. If you're in one of the more highly populated areas, you will not see these because they're not allowed in the highly populated areas. These can only be issued or underwritten in communities with 20,000 or fewer people. By the way, a bunch of areas that did qualify for USDA financing just rolled off of that list last month.
Wow.
If you're paying attention, the census numbers were released last month. Don't we do a census every 10 years in this country?
Yep.
And
Yeah.
so the areas that are eligible for USDA financing are always based on census counts. So think of areas around your big cities. Are there going to be areas that when the last census was done 10 years ago were not really populated with maybe fields and farms and those kinds of things? And throughout the last 10 years, maybe housing developments got built up in there. Y'all following me so
Yes.
far? Well,
Yeah.
remember that area was qualified for USDA loans because it was rural 10 years ago. So all those houses being built, could those people the first time around probably have gotten a USDA loan?
Yep.
What do you think?
First time around, yes.
Yep.
Yeah. But now when they get ready to sell that house, can the person buying it from them get a USDA loan? Probably.
No.
Not.
No, because that new census has come in and said this is no longer a rural area and this loan's not available here anymore.
Now I'm just gonna throw the link in the chat because I would want to be the one to know how to look it up.
Yep. You can go on to the USDA website and type in any address in the country, and it will give you that property's USDA eligibility. You can look up and it'll say the property is eligible or the property is not eligible. It's really actually super easy to look up and see if you can do USDA financing. And the benefits of it are it's 100% loan to value, so people can buy property in rural areas. It's meant to incentivize growth in rural areas. That's the
Yeah, it looks like on the map, I know this is very small topic, but it does look like here on the map that they have little shaded areas around the cities that are not eligible just right off the bat. So I think that's
Sure.
cool to look
Oh
at.
yeah, when you pull up a property on the map, you can zoom in and out, and you can actually see where the eligible areas are. So you could see, like, for example, how far you'd have to go out of Raleigh to get to an eligible area on the
I
map.
just have to. I'm sorry. I just think this is very cool. I'm going to share it really fast. And
I
then
knew it was coming. That's why I was pausing here.
it's cool. See, like all of Raleigh right here is totally uneligible. So same for Durham. Can you see that?
Yep. We see it.
Okay, cool. Sorry.
So on that map, the white areas were eligible, and the sort of more almond shaded areas were not.
And it's pretty consistent around all those major cities.
Yes, for sure. Well, it's based around population. So, where you have population growth, you're not going to have the availability of them. You may see a couple test questions about construction loans. First thing to understand about a construction loan, these are loans made for the purposes of building something. In other words, we are borrowing money from a lender and using that money to construct an improvement on the property. Is everybody okay with that definition? Okay.
Yes.
because the structure is not yet there when the loan is issued, these are the riskiest loans in all of real estate. Because think about it, normally you would want the property to be the collateral for the loan, correct? Well, if somebody comes to you and they have an acre of land and they want to build a house and they come and say, well, I need a $300,000 construction loan, and you give them a $300,000 construction loan, what if they just take the money and run and never actually build anything? You foreclose on it, but all you got is a vacant piece of land.
You don't have collateral.
Right. The collateral is not worth nearly the money that you've loaned out. So these are very, very risky loans to make. And because of that, there are some typical things that you should recognize about them. Number one, they are temporary. Oops, back. Sorry, I didn't mean to do that. They are temporary loans. Most construction loans are meant to only last just long enough to get what done?
Build the house. And the improvements.
Build the structure, whether that's a house or whether that's a shopping center or whether that's a office complex, whatever it is. This loan is meant to be made just long enough to get the construction finished. The other thing to understand is that very few lenders are actually going to issue the loan in full. Look at this statement right here. It says the loan is probably going to be paid out in installments or draws. That's a protection for the lender. What do you think the lender is going to want to do? Go investigate the property and make sure. So if the lender issues the first $50,000 and then a month later, the builder comes back and says, okay, I'm ready for the next 50,000. You think the lender's just going to issue it, or are they going to want to go out and inspect and make sure $50,000 worth of work is actually already
We
been
want
done?
to inspect it first, yeah.
They're going to want to verify along the way and see that this work is being completed. So another thing to recognize about construction loans, they almost always come in draws, not all at one time. And then you need to know this phrase right here. I'd say that phrase might show up on a test. The takeout commitment. That's the language in a construction loan that says you have to refinance this thing as soon as it's done. That's what makes it temporary. Basically, the builder is committing to refinancing as soon as construction is done. A lot of times you'll hear people refer to it as, oh, well, we have a construction to perm loan. Well, the perm is short for permanent. In other words, they took out a construction loan, but they made a commitment that as soon as it was finished, they would take out what kind of a loan?
Permanent.
Permanent loan.
A more traditional permanent loan, right? And
Is this the same as a bridge loan?
Well, bridge loans typically would be made on transactions where you are simply bridging the gap from one transaction to the next, not where the money was being used to actually build something on the property. So an example of a bridge loan might be this. Let's say that Patty is purchasing a new home and she needs to sell her current home to use as a down payment on the new home. But she doesn't want to risk selling her current home and then not having anywhere to go. So she goes to the lender and says, can I borrow $200,000 as a bridge? 2 months. I want to borrow $200,000 because I'm planning to sell this house. And as soon as I do, I'm going to pay you off. But I just want to borrow that. That's a bridge loan. The money's not being used to build anything. It's just being able to bridge from one transaction to the next. A construction loan is actually we're issuing the loan, understanding that the money is being used as it's issued to build things on the property.
One more question. So if I buy a piece, like someone buys a piece of property and they need to fix it up so that they can sell it, would they use a bridge loan or construction loan to do that?
It would not be a bridge loan because you're not bridging from one transaction to another. You're using the money for improvements. So it would either be a construction loan, or there is a lesser version of a construction loan called a rehabilitation loan. Depending on how much work you would do on the
Okay.
property, you might be able to do a rehabilitation loan.
Gotcha.
Very cool.
Thank you.
Yep. Okay. Blanket loans simply are loans made on more than one piece of land. Normally, remember, these loans are specific loans. There's a blast from the past terminology. What does a specific lien mean? It attaches to what?
Property.
One property.
One specific piece of property. But if you think about like subdivision developers, when they first are subdividing the land, how many of those lots does that subdivision developer own?
All
the lots.
All of them. And if they have debt on the big piece of property, they need that debt to attach to all of the small pieces of property so they can get it subdivided. Does that make sense for everybody? So
Yes.
think of a blanket as something you throw across the whole subdivision. A blanket loan is a loan made that attaches to every lot in the whole subdivision. Well, obviously, the only person who can do that is the developer themselves. And here's the benefit. It allows them to pay the debt off in little pieces, because what they're allowed to do is sell a lot and pay off just the amount of the debt that's attached to that lot. That's a blanket loan. Everybody all right with that? Okay. Package loans, I call this the all-inclusive. If you were buying a beach house and you wanted the furniture, the boat, and everything else that was there, you just wanted to walk in. How many of you have watched, I know it's always a danger in talking about watching HGTV or whatever, but you've watched like the ones where they go shop for like beach houses in different places, and they're always talking about, oh, I love the furniture in that one, it's nice. And you're like, well, why is the furniture coming with it, right? That happens quite a lot in vacation properties, because people that are buying vacation properties, the last thing they want to have to do is they're 1,000 miles from home, go furniture shopping. They want to be able to get off the plane and go to the beach, right? So they want to buy, and the people selling it don't want the furniture because they probably live 500 miles away. And what are they going to do with all that furniture, right? So the people selling it want to get rid of it. The people buying it want the furniture because they don't want to have to stock this whole place. And so there's a lot of demand with vacation properties to buy the home and the stuff. Does that make sense for everybody?
Mm-hmm.
Yes.
But remember, normally the stuff is not included in real estate loans. The loan is only attached to the real property on a normal basis. So if you want to buy that vacation home and you want them to leave the boat, and you want them to leave I've done ones up at Lake Gaston where they had, the house came with 2 boats and a jet ski and, all the furniture that was in the house. I mean, literally the sellers didn't do anything but take their clothes out of the closet. That's it.
Travis, is the collateral still just the real property only?
No.
Or could it be the boat?
The collateral was still the real property only. It would be a traditional loan, right? And so that's why this is a specific type of loan called a package loan, because the package loan will actually bring all the stuff into the package. What you have to do basically is take an inventory of all the stuff that's being included in the sale, and all of that would be mentioned. So the boat, the VIN number for the boats, the jet ski VINs, an inventory of the furniture would all be actually listed in the note itself, because you're borrowing against not just the real property, but the stuff as well.
Mm-hmm.
I think, my aunt, her parent-in-laws or her in-laws purchased a condo in Myrtle Beach, and it was fully furnished. And I bet you anything, this is probably what it was. But I think William has a question.
William, you had a question?
Well, actually, it's just a comment. Sorry to switch subjects, but you were talking about TV. And my wife just last Wednesday, after we got out of class, said she saw you on TV.
Yeah, I think they showed
on Lever to List It.
I think they showed it on Labor Day. Yeah, it was on last week. So yeah, they show it too much. It's on there too much. So hopefully she got a kick out of it.
Very cool.
All right, so that's the package loan. Specialty loan types, William already mentioned the bridge loan. Bridge loan is just temporary financing. but you expect to have the cash very soon. I've seen people do bridge loans who were expecting an inheritance. You know, I've had clients over, you know, a couple of times over the years come to me and say, well, my parents passed away and I'm waiting for the life insurance settlement, but I want to go ahead and buy this house. And I want to pay cash with the house because I'm going to have enough cash, but I don't have the cash right now. How do we do that? Well, a bridge loan is perfect for that. It is perfect for somebody who knows they want to buy something right now and they don't have the cash, but they will have the cash soon. Does that make sense for everybody?
Yes.
Yeah.
Yep, it does.
I've seen people do bridge loans who were taking the money out of their 401k and it was going to take, you know, 30, 45, 60 days to get the money out of their 401k and they needed to close right now. So to do a bridge loan. And so they're just, it's meant to be very short term, which means it's probably going to be at a very high interest rate because that's really the only way the bank can make you pay it back in a hurry is charge you an ungodly interest rate on it if you don't. So you usually be like, you know, a reasonable.
A lot of points on those because they don't end up earning the interest over time.
Right, exactly. So you pay dearly for them for the amount of time you have them, but they're very useful for that short amount of time. Reverse mortgages, simply reverse the process. Instead of the lender, because think of a loan, money actually goes both directions in a loan, folks. If in a traditional loan, you get a big lump sum of money paid to the borrower up front, and then the borrower makes small payments back to the lender over time, right? Isn't that how a traditional mortgage works, right?
Mhm.
Yes.
Big lump sum of money to the borrower up front, small payments made back over time, okay? In a reverse mortgage, you do it in the opposite direction. There is no big lump sum of money paid to the borrower up front. The borrower is taking small payments all along from the lender. This is designed for people who need to supplement their living expenses. This is for people who cannot afford the current cost of living for themselves, but they have equity in a property. So they are slowly but surely borrowing against the equity in the property. It can be a valuable tool for somebody like, as an example, well, like for me, I'm probably the perfect candidate for a reverse mortgage at some time in my life. I don't have children. I don't have brothers and sisters. I'm old. And I'm not going to have any debt on my house in another couple of years. Well, at some point, when I reach a certain age, doesn't it make sense to start, especially if I need the money? If I don't need the money, that's one thing. But if I needed the money, if an extra $1,500 or $2,000 a month would make my life more comfortable, wouldn't it make sense to borrow that money every month against the equity that I have in the house, which it doesn't really matter to me anyway, because I can't take it with me, right?
Yes.
And so, but of course, the downside to the reverse mortgage is for people who do have, you know, children and heirs and all those kinds of things. The children think, oh, I'm going to inherit mama's house. Maybe not if mama got a reverse mortgage, because mama's been borrowing money against that thing the whole time. And that's got to be paid off. And most people who have reverse mortgages don't have cash to pay the mortgage off when they die. So what's got to be sold to satisfy the reverse mortgage?
The
Property.
The house, the property. That's exactly right. That's exactly right. And then the HELOC, the home equity line. The home equity line is a secondary type of mortgage that is not taken out. In most cases, it's possible to take it out at the time of purchase, but that's not the general purpose of them. A home equity line is designed to be a loan that you go and obtain at some point when you want to borrow against the equity in your property in one lump sum. You want to take out a one lump sum. Hey, I want to borrow. The most common time these are done is like with home renovations. You know, like for as an example, you go and you want to do $100,000 home renovation and you don't have $100,000 in the bank, but you do have $200,000 in equity in your property. You could probably go and take out a home equity line, which would allow you to essentially borrow against the equity. And by the way, keep your other financing in place. If you already have a mortgage in place, that mortgage would stay in place. You're just taking out an additional line of credit that's borrowing against the equity that you have in the property. That's a
I
home.
think my grandparents did this to help me finance my first car.
Yeah, a lot of people do them for a lot of things like that. You know, is you go out and borrow against the equity in your property. People do it for college
For college.
expenses,
Oh.
right? Yeah, college, people do college expenses a lot with home equity lines. And so they're, you know, or buy a car with a home equity line if especially if you can get a lower interest rate on the home equity line and you could get on the vehicle, why not do it as a home equity line? You know, essentially pay cash for the car, but borrow it against the equity in your house rather than taking out a car note if it's at a lower interest rate. So there are lots of options with the home equity lines. And one other terminology you might see on the test is subprime. Subprime simply means borrowers who are high risk and don't fit into the traditional molds. These are borrowers who probably don't qualify for conventional loans. They don't qualify for FHA loans. They don't qualify for VA loans, and they still want to get financing. There are lenders for almost everybody, but you have to be honest with yourself. If you're a borrower who can't qualify for any of the major loan types, do you think your lender is going to go easy on you on the interest rates, or is that probably going to be a much more expensive loan to obtain?
Mm-hmm.
Yeah. Now, I will tell you, and I'm not going to have much of a soapbox moment, but I am going to have a soapbox moment here for you. As a real estate broker, the hardest thing in the world is to tell somebody you shouldn't be doing this. And the reason that's the hardest thing in the world to tell somebody is that we are in an industry where we generally don't get paid unless something closes, right? You know, giving the advice to a buyer, I just really don't think you should be buying this property. It's hard for us because it's hard for us personally, but it doesn't mean it's not the right advice in certain situations. People who obtain subprime loans in order to purchase homes, that almost always ends badly, in my experience. And that's from my personal experience. Are there success stories? Yes, but most of them end badly. And what I'll tell you this is that that's not good for your client, but it's also not good for you, because it will wear on you when you realize that that person you sold that house to 2 years later is in the foreclosure process. It will hit you in a way that you don't expect when that happens. And you will feel some level of guilt about that. And no matter how much guilt you do or don't feel, inevitably what you will experience is they will blame you. Whether it was your fault or not, you become the face of these transactions. And so when somebody asks that person about you 10 years down the road, hey, well, do you know Travis? Oh, I wouldn't use him. We bought a house through him. It was the biggest mess ever. We got foreclosed on, just like the foreclosure was your fault. But if you have borrowers who are considering subprime loans, I would really, really encourage them to take a long, hard look at why they're doing that and does that make sense? Because I don't want you to be caught in a bad situation, and I don't want your clients to be either. It's not, sometimes the commission is not worth it. And so that's my soapbox moment. That's all you get out of me on that soapbox. It's you know, it's a business about
you got real.
Yeah, well, it's a business about caring about people. And I'll tell you, my entire career, worst experience ever for me. And I carry it with me. It's seared into my brain. I went to this tells you how long ago this was. I went to my 10-year high school reunion a long time ago. And my 10-year high school reunion was in the height of the real estate boom of the mid 2000s, when everybody could get a loan. I mean, you know, and we called them ninja loans. No income, no job, no assets. Doesn't matter. You know, it just didn't matter. If you had a pulse, you could get a loan. I mean, literally, you would go in and you would sit down with lenders and they would say, well, you know, to qualify for this loan, you need to make $250,000. And And the borrower would look at, the borrowers would look at each other like $250,000. And here's what the lender would say. The actual lender would say, now, I'm just telling you to qualify for this loan, you need to make $250,000, but we're not going to check. We're going to trust you. Whatever you put on that application, we're not going to verify any of that. So, as long as you say you make $250,000, then you make $250,000, folks. That's what people did. They lied. And they qualified for loans that they never should have been qualified for. And they went out and they bought home after home after home. And, the stories really are true when you talk about like the young lady who's working as a part-time waitress at the diner on the corner, but owns 6 investment properties because she went out and got all these loans, and when that thing fell apart, it was ugly. But back to my personal part in that, or the one that always sears in my brain, I went to my 10-year high school reunion, and I was talking with a really good friend of mine from high school who I had not seen since we had graduated. We played football together. We were both on the offensive line. We literally played side by side on the offensive line. We had been good friends in high school. And when he found out I was in the real estate industry in the Triangle, he said, man, we're about to move to Raleigh. You can help us buy a house. And of course, I'm like, sure, I'd love to help you. I can't think of anything better, Chris. And I'll never forget, we started looking and his original price point was like $275, which was a pretty decent number back in those days. And we looked and I found what I thought were some great options for them. And they kept wanting to push the pricing, push the number and push and it got further and further and further out of hand. And I went on vacation one weekend and I came back and Chris called me and he said, listen, you can be getting a call from somebody at, and I'm not going to say the builder's name, at one of the big national builders, and they're going to send you a contract. I said, they're going to send me a contract that you're thinking about signing? He's like, oh no, man, we already committed to it. We couldn't miss out on this one. It was too good of a deal. When I got that contract, folks, now keep in mind, we've been looking at houses in 275 to 285 range. $547,000.
Oh, wow.
And it was the builder's lender who qualified him for that loan. It was a subprime loan. It was an adjustable rate loan. And I said to him, I said, you can't afford this house. And he said, oh yeah, they qualified us for it. I said, I don't care what they qualified you for, Chris. You make far less money than me and I can't afford this house. I remember having that conversation with him. And of course, he bought the house anyway. And 2 years later, he was foreclosed. And he had a 2-month-old and a 3-year-old.
Oh.
And folks, when I'm telling you, you take your client's problems home with you, you don't have any concept of how heavy that burden can be. You don't want to experience that. And did I do anything wrong in that transaction? No. But I still wish to this day I had been a hell of a lot more forceful. I wish I had screamed at him. I wish I had just demanded, how are you going to pay for this? Because it will affect you too. So
everything happens for a reason.
Are there many subprime loans out there now?
Unfortunately, they are coming back with a very strong prevalence now, as lending, that is the nature of lending. What happened after the collapse was everything tightened up and people who should have gotten loans couldn't get them. It got too tight.
Yeah.
Now over time, it slowly but surely loosened and loosened and loosened. And you it's happening. If you listen to on the radio, I heard on the radio the other day, there was some company that was advertising that they do loans based on your bank statements rather than your tax returns. They specifically say on the commercial, we won't require income tax transcripts. We do it based on your bank statements. They're literally advertising, folks, if you're a tax cheat, we will lend you money. That's why they're saying that, because the only reason there's a difference between your bank statements and your tax returns is you're lying to the federal government. I hate to tell you, but that's the truth, right?
It would work for me.
And
when we're recording.
And so, just keep that in mind. just keep in
That-
mind that these are people's lives, and
Don't upload this.
it's
Yeah,
not.
that's what got me out of real estate. I sold real estate back in early 2000s. I got my license at like 2000, but I only sold for like 8-9 years because the market went under. But what I was doing was I was using that subprime market because there were a whole lot of people who weren't able to get property that were able to get it. So I thought I was doing everyone this great service by letting them, helping them get property. And then when everything went under, everyone looked at me like I was the bad guy. And it was just really ugly because you do take that stuff home. You sell a house for 300 and then the mortgage went down and they say it's now worth 200.
Right.
And people were like, I was the bad guy.
Yep. And so I always point that out. Every commission is not worth it. So.